So when you start this whole process, there are kind of 10 questions you need to ask yourself to be ready for this. Because when I meet with clients, you know, I have this list in front of me that I go through this questionnaire with them, and I have a questionnaire I pass out to them. But the first deal is, who's going to be in charge of this? You die, who do you want to administer your estate? Who do you trust? And with regard to things that happen before you die, who's going to be your power of attorney so that you become incapable or incompetent to handle your financial affairs, but you haven't died? Who is that person? It needs to be somebody that you trust. It's typically a beneficiary or relative. And then you need some successors to that process, because many times somebody is either unable or unwilling to serve, or they're just, and so you got to have a second choice. And typically, I always recommend that there be like a third choice that's eventually an institution that you know is not going to go away, so that you know you have a succession plan in place, so that your first one or your first two people can't serve or are unable to serve or won't serve. You've got an institution there that you trust and that you know is going to, might be a little more expensive, but they will handle your money and they won't steal it. The next question is who gets your stuff, and how do you want them to get it? Basically, that is, if you have minor kids, do you want them to get it outright, or do you want it to go into a trust for some period of time, or do you want it, if you have enough where it's enough for your kids and successive generations, you might want to do something like a legacy trust where it goes into a trust for their benefit during life, but they don't ever get it distributed in bulk. And even if you have adult kids, a lot of times you don't want them to get it in big chunks. If you got college kids, they might want to go out and buy a Ferrari. If you got a high school kid, they might not want to go to college. So you might want to put it in a trust for them and get it in pieces where they get it at 30, 35, and 40 in shares. What this also does is not only protects them from themselves, it protects them from creditors. So if it's in a trust, if they make mistakes, the creditor can't take their money that you've worked so hard for. The next question is you want to deal with this specifically because sometimes, especially if you have a will in place for a long period of time, one of your beneficiaries will predecease you. And if your will is silent, each state has what they call anti-lapse laws. Anti-lapse laws provide that basically it's treated as if that person predeceased you, and it goes to, if they have children, it goes to their children. And so if you, for instance, if you have 3 kids and one of them dies before you, and you want it to go to your other 2 kids, you want it to go to their spouse or something like that, you need to address that in your will, so that it's very clear what your intent is, because judges, probate courts bend over backwards to find out what your intent was. But again, if you don't express what that intent is, the state has, through their probate codes, rules to specifically state who's going to get it, so there's no uncertainty. The biggest problem that I find that keeps people from ever getting through their wills, even after the initial meeting that we have, when they sometimes even called me and said we need to get our estate planning documents in place. And it's sort of like marriage in the sense that when you get married, everybody presumes their to-be spouse is thinking the same way they are on every issue. And what happens is when they get down to these things, it's one, unless you do a lot of premarital counseling and everything else, is you're just presuming that your spouse is thinking the same way you are, as if you were to both die. Who takes care of the kids? And you know, the wife usually thinks, well, their family's much more equipped to handle it than the husband's family, and the husband thinks the same way about their family. And so this actually creates the most angst among young couples, especially with minor kids. And I'll tell you, too, for me, we have 3 children. I felt a huge sense of relief when my kids got to college, and this was not an issue on the table anymore. But again, it's rather than to delay everything and avoid the question and just sweep it under the rug, it needs to be addressed because, again, the state has plans for you, and you really want your kids to be handled by somebody that you guys choose instead of somebody else. So don't put it off for that issue, but it is recognized going in that that is the big issue that I see over and over and over again with the kids. This goes back to our prior question is that how do you want your estate to be managed in the sense that do you want it when you die for your assets to go directly to the beneficiaries where they own it, they control it, they do whatever they want, or do you kind of want to control it from the grave a little bit, in the sense that you think they're too young or you don't want creditors to get what you've worked really hard for? And so most of the time, whether their kids are minors or adults, they put them in trust for a period of time and then leak it out over 2 or 3 distributions, so that if they make a mistake and lose part of it, that they don't lose it all. And this goes along with the concept of most lottery winners within 2 or 3 years of winning the lottery, they're broke. And so you don't want to spend your whole life building up this estate only to give it to your kids and have it be gone with a year or 2. So it gives them a little sense of an ability to learn how to deal with some of this money, and so they don't just spend it all right away. Again, this goes along the same question. Typically, I would see that there are 2 choices here, and that they get it like maybe at 30, 40, 45, or 30, 35, and 40, because it gets them past college, it gets them into the careers. The other advantage of putting it in a trust is if they were to get divorced, and a lot of times if you die early, you don't know who they're going to marry, you don't know if they're going to make good decisions or bad decisions, but you're not basically building up this estate for you so that their spouse can walk off with all your money if you were to get divorced. And even if they inherited it, it's their sole and separate property. But what happens is, if it's not in a trust, is it tends to get commingled. And if it's commingled, then it becomes marital property to get divorced, and the spouse is walking off with a lot of the money that you never intended for a divorced spouse to have. You intended it for your child, and you intended it for your grandchildren. And then, as I said earlier, if you have a ton of money that's going to last a long time, it's a good idea to just drop it down from one generation to another generation so that it can be preserved. And that comes to a fundamental question is how much is the estate worth? This used to be a bigger issue than it is now because, and I'm not going to get into state laws because every state has a different level of what part of their estate becomes taxable. But on the federal level, and if anybody wants to ask me about it later, I can deal with their specific state. But on the federal level, each person has a lifetime exemption and an estate exemption of $5,430,000. So unless your estate is worth more than that, it's not subject to tax. And if you're married, you get to double that. So you have $10,860,000 before you have any concern about building any kind of tax planning into your estate. Most people just never get there. But having said that, you need to address it from time to time because the state, when the political parties change, the state laws change, the tax laws change, and so what might be the rules today might not be the rules down the line. In fact, in 2010, they eliminated the estate the estate tax, and so if you died in 2010, no matter how much you're worth, it passed tax-free to you. But that's the key to to one is it taxable, and do you have to put some tax planning into place? And two, is there enough to where you want to put it in a trust, or if it's a small amount, just give it to them outright and don't incur any trust fees or anything else. One thing I will say, going back to guardians and trusts, is that you want to make sure that the guardian is usually a different person than the trustee, so that you make sure that there's a kind of checks and balances on what happens to your money. Because a lot of times your money has a tendency to disappear. And if there's a guardian that has other kids, they're a lot of times spending your money on their kids. The taxes we addressed a little bit. Basically, on the estate level, there are no taxes on your estate unless it's worth in excess of $5,430,000, and then only to that excess. There is one area where people get confused, and it's something called income with respect to a decedent, and that has to do with, this is not a, there are three kinds of taxes. There's income tax, there's estate tax, and then there's gift taxes, and inheritance taxes. There's no estate tax unless on the federal level unless it's $5,430,000, and there's no inheritance tax. But if you inherit money that's been in an IRA or a 401k or an annuity that hasn't been taxed before, that it's all pre-tax dollars, well then the decedent has never been taxed on that money. So that money that hasn't been taxed is taxed as ordinary income, just as it would be as had the decedent taken it out of the account and then had to pay the tax on it. There's no estate tax on it, but there's an income tax on it because the decedent never paid the income taxes. Okay, this is another question that comes up is you can avoid the probate process, and in some states it's important to avoid the probate process, and because California, for example, has a very difficult and expensive and court intrusive probate process, and so that's where these living trusts really got born. And the idea is that if your probate covers your probate estate, and your probate estate includes everything that's in your estate that hasn't gone, that's not been put in a living trust, so the trust controls it, or there's three groups of assets that pass automatically outside of probate, and so it doesn't make any difference what you did. And that would be if you have joint accounts, like bank accounts, where you have joint owners, and the surviving owner, it just automatically goes to them. If you have real property and it's owned as joint tenancy with right of survivor, the survivor automatically gets it. Or if you have bank accounts or life insurance policies or annuities or 401ks or IRAs, and they have a designated beneficiary on them, that money goes directly to the designated beneficiary. It doesn't matter what your will says. The will doesn't control anything. It doesn't make any difference what your living trust says, because it doesn't control anything either. These assets go automatically. So this is, if you don't want to go through probate, you structure all your title, all your assets like that, or you put other assets into a living trust. And so when you die, there's no probate estate and no need for probate.